I'm John Hanna for CityTV.net in New York, and we have Greg Womack, President of Womack Investment Advisors, joining us at Edmond, Oklahoma. Hey, Greg, good afternoon.
Good afternoon, John. How are you?
Great, sir. Great, sir. How's the weather out there?
You know, it's beautiful spring weather. We're having, nice spring weather. Just a couple weeks ago it was 95. Now we're in the 70s, so liking the spring weather.
Well, you got a beautiful 70 degrees there, but we have currently about 55 degrees here in New York. Greg, what do you have for us today?
Well, last week the markets had an up and down week in the equity markets. We had a sell-off on Friday. The NASDAQ finished down 1.2% for the day, while the Dow and the S&P both finished down a little under 1%, essentially leaving the indexes back where they started the week. Commodities, which have been on the front burner and really a nice correction with the last few weeks, they moved in lockstep with the equities. They also finished essentially flat for the week, with oil closing just under $100 a barrel. Investors had lots of reason to be skittish. We had a strengthening dollar. You had renewed anxiety over the cost of the Eurozone bailouts, and an unexpected increase in U.S. crude oil reserves, and coupled with a reduced demand for gasoline and inflationary pressures at home and abroad, all led to some concerns about the U.S. and global recoveries. We did have a better than expected reduction in initial claims for unemployment benefits for the week, the only real positive news for the period, but this couldn't do much to calm those fears in the market. Year to date, John, the Dow Jones Industrial's up about 8.8%, the NASDAQ's up about 6.6%, and the S&P about 6.4%. As we speak today, we're seeing pretty much the market's flat for Monday, the 16th. We've basically are up just a hair on the Dow, about 15 points as of 12 o'clock Eastern time. So last week's headlines, despite the record exports of $172 billion in March, the U.S. trade deficit widened to $48 billion, the largest monthly deficit since June of 2010. Also, the Department of Labor reported initial claims for unemployment benefits for the week ending May 7th that totaled 434,000, a decrease of 44,000 from the previous revised week of 478,000. Now, this was the steepest weekly decline since February of 2010. However, the 4-week moving average was 750,000, an increase of 4,500 from the previous revised average. So, unemployment still, a little bit of a positive signs, but still we've got a lot of weakness there. We look at the CPI index. It did rise 0.4% in April, primarily because of higher food and energy costs. Gasoline prices alone accounted for almost half the monthly increase. Wholesale prices for finished goods, the PPI, the Producer Price Index, were up 0.8% in April and 6.8% for the 12 months ending April of 2011. John, this is the largest year-over-year gain since September of 2008. So, the PPI is a pretty good indicator perhaps of coming or future inflation or consumer price inflation. Now, if we look at import prices, we had an increase of 2.2% in April, followed by a 2.6% increase in March. This the first time import prices increased by more than 2% in consecutive months since June 2008. So, import prices are going higher year over year. The increase is 11.1%, the largest 12-month gain since April 2009 to 2010. So export prices increased 1% in April and 9.6% year over year. So imports are doing very well on our end, but we're not exporting this much. So if we look ahead, John, the looming decline for increasing the U.S. debt ceiling, we'll have discussions in Brussels about the worsening Greek debt situation and the volatile commodity prices will all compete for investors' attention this week. Some of the key releases this week are international capital flows on the 16th, housing starts and industrial production on the 17th, the Federal Open Market Committee minutes on the 18th, and home resales on the 19th, and this Friday we have options expiration. Now, John, I want to end on a note here that asks a question. What are the two things people tend to buy less of when the prices go down? You know, normally people like a bargain. When we go shopping, we feel better about when things are 20% off or buy one, get one free, right?
Yes, me too, definitely.
But can you take a guess of what are the two things that tend to buck this trend of buying when the prices go down?
Buying the prices go down. I think probably the stock market, right?
That's a good guess. In fact, there are two things people tend to buy more of after the price has really run up. And so what are the two things? Stocks, as you mentioned. And what is the other?
I can't think of anything right now.
How about real estate? According to the most recent S&P Case-Shiller home price indices, home prices on average across the U.S. are back to the summer of 2003 level.
Wow.
What that means is they're the cheapest they've been in about 8 years. So
wow.
Americans are clamoring to buy homes? Not really. In February, new home sales in the U.S. fell to a record low on a seasonally adjusted rate, according to the Market Watch. And yet during the boom times in 2005 and 6, when prices were, and sales were at their peak, people were buying homes like crazy and flipping them. Now, to take stocks, for example, history suggests that people tend to shun them when prices are down. A good example, how many Americans were loading up the truck to buy more stock as the market was declining to its recent low in March 2009?
Probably a lot.
Not many.
Oh, really? Really?
People
Okay.
were scared to death of stocks back then.
Oh, all right, I see.
Yeah, 2009, when the market was tanking and in the world the sky was falling.
Right.
People shunned stocks. Yet how many felt comfortable buying internet stocks in late 1999 as prices were zooming?
Oh yeah, I have to be honest here. I was one of those guys buying the internet stocks.
It's hard not to get caught up in the party and the frenzy of things.
Yeah.
But these are two examples, John, suggest that housing and stocks are two major categories that defy traditional expectations. So knowing that, being a contrarian investor in these assets may be the best long-term plan. So that's just some food for thought for all of our listeners out there. When things aren't attractive, it's the best time to buy usually. Sometimes you have to hold on a while to get your return, but it's better than running off the cliff with the rest of the herd.
That's Greg Womack, president of Womack Investment Advisors, joining us from Edmond, Oklahoma with his Food for Thought. And I'm John Hanna for CDTV.net in New York.